Well, hello everybody, and welcome to another UPotential webinar. Thank you for joining me on this snowy day, if you're actually listening in on November the 30th. As always, this webinar is going to be recorded and made available on the UPotential website. You'll also be receiving a thank you email if you've registered. And as always, I would love to hear your comments and your thoughts, questions for future webinars, things like that. Also, if time permits, I will try to address some questions at the end of today's seminar as well. So you can always send those in while I'm speaking. As always, let's just do a quick introduction. For those of you who may not have listened to a UPotential webinar before, I welcome you, and I'll just give you a little sense of my background. I have been in the financial services industry for quite a while, almost 20 years, and my background is exclusively in fee-for-service planning, meaning that I don't sell any mutual funds or stocks or insurance. What we work with is either, actually, it's quite a broad range of clients we've worked with, those who are very high net worth and those who are very vulnerable. So if someone were to ask me, for example, who would get the most out of our work together, I would probably say that anyone who's kind of facing a decision or a crossroads in life, that's really who can best benefit from fee-for-service work typically. And that decision could be anything from creating a budget to understanding, at the beginning of your life, what standard of living is affordable for you, all the way through to very complex situations involving estate planning, tax planning. I do have a specialized degree in divorce planning. So obviously very broad set of clients that we work with. And really what the work that we do together does is it provides you a context from which you can then go ahead and make decisions with some confidence and knowing that there's been a very broad set of consideration of factors that helped you make that decision. Professionally speaking, I work with clients basically in two realms. I have one hat where I'm the head of financial life strategies for UPotential. That is a fee-for-service business unit of Quintessence Wealth. And I also offer that exact same service to the clients of ETF Capital Management, which is a discretionary money manager based in Toronto, but working nationally. I'm thrilled to be partnering with the ETF Capital Management people because they really do believe in the necessity of both investment strategy and execution. But for those who like to do their planning on their own and would either like to work with an external investment advisor or are do-it-yourself investors, then UPotential is the client basis under which I could work with you on a fee-for-service basis. And just to reassure you, the advice is exactly the same. Unbiased advice, looking at retirement planning, tax planning, and all the various different sectors that I talked to you about before. So although we're going to primarily be looking at the events of 2021 in this kind of a look back webinar, let's just give some pause and kind of think of where we were all about a year ago. So if you think back to November 2020, I mean, it feels like ages ago. The US election results were still really hotly being debated. There was all sorts of accusations of voter suppression and fraud and charges against the company that prepared the automated systems. If you recall, I think they were called Dominion Voting Systems. And really, there was actually no idea of what was yet to come by way of the insurrection on January 6th. A year ago, November 20th, 2020 rather, COVID-19 cases were on the rise in US and Canada. Maybe again, largely attributable to the Thanksgiving get-togethers, despite restrictions that were in place on inside gatherings at that time. And funny enough, and very hard to believe, no one had even heard of Bridgerton, which really only debuted in December of 2020. A year ago in the economy and in markets, the federal Liberal government had just announced its fiscal plan, which was focused on supporting the travel and hospitality industries. Um, the fiscal plan also had set very ambitious plans on subsidized daycare that would kind of mirror what Quebec is already doing and that we're all, outside of Quebec, very, very jealous of. But really, all of these opportunities were really trying to address what has been largely referred to as the she cession, meaning that an inordinate number of women either had to leave jobs voluntarily because their preschool kids didn't have programs, or their school-age children were forced into online learning as a result of COVID, or were simply, forced out of the workforce entirely because there is still female prominence in the service industry. Specifically in markets, Bitcoin at that time was trading at about $19,000 US. Last time I checked, a couple of days ago, it was nearly $60,000 US. Now, I checked before all of the talk about the new corona strain, but even so, clearly multiples of where it was a year ago. The TSX was trading then at about 17,000, and again, just before the concerns about the newest virus strain. Last time I checked, it was about 21,000. So again, a lot had happened. And if you recall, GameStop had really yet to face its crazy, crazy ride in January. It was selling at about 16.56 in US dollars in November. And last time I checked, it was at 228 US dollars. So a more than tenfold increase in the value of those shares. Now, again, please don't misunderstand. I'm not suggesting that any of these are good opportunities. They may not be, but it just gives you an idea of, I really do not pay any mind to individual investments. That's for the investment advisors. The work that we do has to do more with strategy. When it comes to the way we think about the past year, it's not hard to look back with a fair bit of regret because, of course, hindsight really is 2020. But a lot of economists would tell you that really the direction of whether it's politics or economics or the business industries, they're not nearly as important as whether the movements in these markets were anticipated or whether they were a surprise. And in fact, there's actually an index that measures whether stock prices, inflation, and sort of other empirical measures were as analysts would have expected them to be, or if they were contrary to what was expected. And this is called the surprise index. For example, it would look at whether a company beat its profit targets or not. So let's look at an example. I'm embarrassed to tell you how much time I spend on Netflix. And if we were to look a year ago, we were still in the first, let's say, official year of the pandemic, and Netflix stock was trading at about 491 US dollars. Now, there's no question that Netflix is one of the few companies that profited by stay-at-home orders. But look at where it is now. As of the close earlier this week, again, when I last looked at it, it was trading at $658 in US dollars. And the surprise index would really only be concerned about whether Netflix beat or missed its target. It's not looking at the prospects over the coming year. With much of the world now, again, maybe closing up a little bit in light of the new variant, but prior to that opening up a bit, you might be skeptical about the trajectory of this stock in the coming months. But again, that's not what the surprise index is looking at. The surprise index just judges whether analysts correctly predicted the earnings. And just so you know, by the way, Netflix beat analysts' expectation for the third quarter of 2020, but then still lost 2.2% in its trading value in the first day trading after the earnings were released. So it's really no wonder that I try to displace or divorce myself from investment markets, because I simply don't have the stomach for it. That's why I like working with a discretionary money manager. As an example that's a little bit closer to home, let's look at, the looming concern about inflation. Inflation numbers have skyrocketed in the last few months. So people are speculating as to whether this is just, let's say, the natural course of a rebounded economic cycle. So just to give you some context, when economies are strong, people demand higher wages. And then as they receive those higher wages, they are temporarily available to spend more. And that's actually what feeds inflation until such time as, of course, um, there's a bit of a reversal of fortune. Others are saying, by the way, that inflation numbers that we're seeing today are overstated simply because it's actually a manifestation of months and months of manufacturing and shipping slowdowns from worldwide stay-at-home orders. Again, it's important to keep in mind that from a financial planning point of view, this is really important because inflation is going to affect your affordability in the future, which often again translates into you requiring a bigger amount of capital at requirement to fund your retirement. So today I'd like to briefly touch upon three important concepts in the past year. Specifically, I want you to consider the real power of capital losses, and I'll explain to you how those work. We're also going to look at how you might take advantage of an unexpected lower earning year for you. If, let's say, your business prospects have been less than expected, or you lost a job, or perhaps you've just retired early, as we're hearing many people have opted to do. And lastly, I'd like to talk to you about certain market timing strategies that actually do work. Now, again, big caveat here. I'm not suggesting that market timing is a good investment strategy. I'll tell you many times over the course of this webinar that it isn't. But we'd all love to get in on an investment at the low and try to predict a good time to sell. But there are a couple of subtle changes in markets that are actually predictable, and I'll show you those. And finally, if time permits, I do want to talk to you about a couple of holiday gifting ideas that actually can help you with your financial plan. Let's start with a look at capital losses. So capital losses result when you sell an investment for less than you paid for it, plus, let's say, some reasonable costs of actually selling it. Those sort of legitimate expenses might be the cost of realtor fees if you're selling a property, or the fees you might fees you might pay to your brokerage to sell a marketable security. Now, obviously, no one likes to trigger a capital loss, but even the best of us have them on our books. Sometimes those capital losses occur because we want to limit our losses when an investment turns sour, or sometimes it's because we have to sell an investment perhaps at an inopportune time because we need the cash. But even though they're unpleasant, don't forget that they can be useful. So as many of you know, when you sell an investment that's gone up in value, you need to pay capital gains taxes on 50% of the gain. I'm going to refer to a particular term in a few minutes called the capital gains inclusion rate. I don't try to use a lot of jargon, but that one's important. So the fact that we have to report 50% of the gain means that the current capital gains inclusion rate is 50%. Now, In contrast, capital losses aren't deductible. We wish that they were, but they can be used to reduce your capital gain in this year or in any of the previous 3 years. They can also be carried forward indefinitely. In some situations, people will deliberately sell an investment that's gone down in value at the same year that they've invested or sold something that's gone up in value, so that the net is zero and they absolve themselves of any capital gains taxes. That strategy is called tax loss selling. Now, if you still have capital losses after eliminating that year's capital gain, you can carry it back, as I said, 3 years or forward indefinitely. Here is where looking back might be helpful. So what I'm showing you here is the S&P 500, for example, for the year 2020. And that awful dip that you see obviously is the beginning of the pandemic. You can see a couple of dips thereafter is probably in tune with when various second waves, third waves occurred. But obviously, 2020 was an incredibly challenging year in markets. So the depiction here shows how dramatic the markets suffered during those initial months. Now, if you think back to where we all were at that time and how frightened everything appeared, really it's no wonder that a lot of investors chose to sell off positions in the face of all that uncertainty. And believe me, I'm offering you no judgment here. For all intents and purposes, it did feel as though the sky was falling. Either way, if you reacted in this way, as natural as it would be, you did report capital losses very likely last year, but those losses could be helpful today. Consider your portfolio today in preparation for the upcoming tax reporting season. Markets have been, significantly stronger in 2021. And if you're managing your investments yourself, I wouldn't be surprised if you're enjoying sizable gains, and you might not be considering any sales at this time. Discretionary money managers, on the other hand, actively trade all year long because they're trading based on the best available information, and they don't tend to employ, the kind of buy and hold strategy that you and I might be using. So actively managed portfolios will likely have gains to report this year and may very well have losses from last year to balance them out. But for those of you who are managing your own portfolios, may I suggest that in the course of what I would recommend anyway, which is a periodic review of your investments, maybe give some consideration to whether the strong markets have resulted in a skewed asset allocation. In other words, where, let's say, your target allocation to stocks and mutual funds that hold them might be 40, 50, or 60%, and because of the strong markets, maybe it's over-concentrated. Similarly, think about whether any particular stock position you have might be over-concentrated. For that, in that perspective, many people might say, any stock that's represents more than 10% of your portfolio, for example, might be over-concentrated. So rebalancing to a target investment allocation, as you probably know, and making sure that your portfolio is not over-concentrated in any one single stock really is a great way to take advantage of market fluctuations. If a market is strong and puts that equity allocation out of whack, then it's probably time to pare down. What that really means is that you're selling at a high. Similarly, if a particular investment suddenly represents that high proportion of your portfolio, as we mentioned, however you decide to define it, then maybe it's a matter of selling some. And if you look at the past year and you're carrying forward losses, well, that strategy to reduce a strong position, it might encourage you to enact that particular strategy because it's going to be removing one of the primary roadblocks to rebalancing exercises, which is crystallizing capital gains. Carrying forward a loss may very well allow you to have the discipline to secure what I'm going to refer to as tax gain selling as opposed to tax loss selling, and really allow you to harness the power of these markets, especially in anticipation of what could be challenging times ahead. I also want to underscore that this can be a particularly helpful strategy for those of you who are accumulating positions in employee share purchase plans. I come across this every day with clients who, let's say, are working at a company that allows you to buy shares through payroll, and they accumulate really tremendous positions. And add perhaps an attractive matching program by the employer, and then you can only imagine how skewed a portfolio can get, with the fact that many of these investors are reticent to pare down these positions for tax purposes. Again, recognizing a capital loss in the year that you recognize a capital gain can go a long way towards reducing that looming tax consequence on these shares and bring the position to perhaps a more reasonable level. Now, where do I find my capital loss, and how do I use it? Your capital loss is reported to you on your notice of assessment. So I know that a lot of people don't spend a lot of time reading these, but maybe take a minute and read it. The only thing to keep in mind is that if your capital loss is really old, I mean predating 2001, this is where that term I referred to earlier, the capital gains inclusion rate, could become an issue. And that is because the percentage that we're currently including in our taxes, 50%, the capital gains inclusion rate back in 2001 and before was actually as high as 75% in some years. So you may need to make some adjustments when you carry back, when you're applying, let's say, losses from way back when, because the capital gains inclusion rate might have changed. If you're at all confused, best to talk to your accountant for more information. And I will try to go through this more thoroughly when I present my tax webinar in the new year. Now let's move on to the next topic of how to take advantage of artificially low earning years. Much has been written about what they're calling the Great Resignation, and that is, just tons and tons of people who have maybe reassessed their situation on account of COVID. And recently I read a statistic that said that up to 41% of Americans aren't currently in the workforce. Now, to be clear, I'm not referring to people who are unemployed. These are people who are not actively looking for work. They may be between positions, or may have taken early retirement because they've had a bit of a change of heart of what they want to be doing in these years of their life. But if you happen to find yourself in between positions, or for whatever reason have lower taxable income this year, which by the way could be early retirement, there are some tax strategies you may want to know about. Now, conventional wisdom would have us defer withdrawals from our RSPs and RIFs and their locked-in counterparts, which are called LIRAs and LIFs, until the very latest opportunity. And as you probably know, this works pretty well in theory, because every dollar that you withdraw from those accounts is fully taxable in the year that it's received. Also, when you withdraw those dollars, they don't benefit from the type of income that it was in the account. In other words, when you withdraw money from an RSP or a LIRA or a RIF or a LIF, if it happened in the account to represent, let's say, a dividend or a capital gain, it loses that tax preference that's available for dividends and capital gains when it's extracted from the RSP. Every dollar withdrawn from an RSP is completely agnostic with regards to how it was produced. It's all taxed as if it had been earned by you through a job or interest income. So delaying seems to work well in many circumstances. But what about those of you who've, let's say, accumulated a huge RSP? Deferring often can create compounding tax consequences with assets that are growing and growing, naturally, obviously, if markets are cooperating, which they don't always do. But over time, they do tend to appreciate. And then what happens is that the amount that needs to be withdrawn and recognized through those RIF and LIF payments also increases. So what do you do then? If this describes you, then you may find yourself wanting to take advantage of any unusually low income years. And in those years, maybe consider deliberately withdrawing funds from your RIF or LIF, or again, the RSP or LIRA. And what you'd be doing is effectively prepaying taxes at a lower rate. Now, this is especially helpful if you have been focusing on RSP contributions and maybe you have contribution room in your TFSA. Then you can prepay taxes on your RSP or RIF withdrawals and put the money into the TFSA where it can then grow unencumbered by tax. Now, this is kind of subtle, so I'm going to show you an example. I worked with a gentleman by the name of Max. This is not Max. This is a stock photo, but hello, Max. Now, Max lost his job in mid-2020, and he's 61 years old and is concerned, maybe rightly, that he could face ageism as he looks for his next position. So in truth, I spoke with him not long ago, and prospects haven't been great for finding work since the pandemic hit. And at this late stage of the calendar year, a lot of companies are now starting to slow down. I'm not entirely confident that there's going to be a lot of active hiring in his industry during the holiday season. Now, thank goodness, Max has a nice nest egg. He's sitting on about $140,000 in cash, largely represented by, the severance when he lost his job. And like many, he has been focusing on investing in his RSP, so he has a very, very sizable RSP. His home is fully paid for, doesn't have a mortgage on it, and typically he needs about $55,000 in after-tax income to cover expenses. So when we spoke not that long ago, Max's first inclination was to use his severance to cover his expenses until he finds work, and that totally makes sense. Now, earlier this year, he received a little bit in the way of the employment insurance program that was in place at that time, but that's ended for him. So I would imagine at this point that he probably has about $20,000 in taxable income from employment insurance for 2021, but not much else in the way of taxable income this year. So when we worked through some of the numbers, I asked Max if he would consider withdrawing funds from his RSP in 2021. Now, this is despite the fact that he's sitting on a substantial cash balance. Now, I won't lie to you, he kind of looked at me sideways. Okay, and it's completely understandable. What I explained to him, though, is that this is an artificially low tax year for him. And so if he, let's say, focused on the upper threshold of the lowest tax bracket in Ontario for him, which he lives in Ontario, that's $46,000. And as I mentioned to you a minute ago, we're anticipating that he only has about $20,000 in taxable income so far this year. So he could effectively withdraw another $26,000 from his RSP before he faces the next tax bracket. Like I said, $46,000 in Ontario. He doesn't need the money, and that's kind of why I understand his hesitation. But if you look at his tax graph here, which I'll explain to you, he could withdraw the money at a lower tax bracket today than he would in a few years' time, prepay the tax, and reinvest the money in his TFSA where it would neither affect his annual tax burden, like investing in a non-registered account would, nor would it affect his future OAS entitlement, which you may recall I've spoken about before. The OAS clawback, is as a result of certain large taxable incomes after the age of 65. So I showed him the graph that you see in front of you. The y-axis, the up and down axis, represents the percentage of taxes that Max pays every year. And the horizontal or x-axis represents years of Max's life. Each black bar represents a particular year's percentage of income that is paid in tax. So you can see on the far left of the graph, which would be 2021, actually it would be 21 through 23, there's actually, his tax burden doesn't even register. It's only for years after 2024, which would be the years that Max would begin to collect CPP and OAS and probably is projected to have exhausted his cash balance. So he'd be prompted to start withdrawing from his RSP in those years. Starting in 24, if you can see, he's already in a 30% tax bracket, or, his annual tax burden, which is again those black bars, is about 16 or 17%. So provided that Max doesn't find work between now and the end of the year, which is unlikely, he could prepay tax and pay, as you'll see in a minute, a lower tax burden that he will in the future. Now, just to keep in mind as we look at this is the before version, I'll show you the after version in a second. In most of those taxable years for Max, if you look closely, the black bars seem to be hovering between, let's say, 17 and about 19% annual tax burden in each year. Now, that's going to become relevant when you see the next slide. Now, this is the after effect of doing a deliberate, isolated withdrawals from Max's RSP in these interim years of low taxes. You'll recall in the previous version from 2021 through 24, there was no tax to be paid, but for the majority of Max's remaining retirement, he was hovering between 17 and 19%. In this graph, his tax burden, including this upcoming year's measured, or this current year's measured RSP withdrawal, finds him in a 15% tax bracket. And if we were to repeat that in the coming years, provided that he doesn't get work, he'll be paying 15% on those withdrawals for the next few years. But the impact over the long term is that there are many, many more years where his taxes are between 15 and 17 instead of 17 and 19 as they were in the previous graph. Now again, I appreciate it's subtle, but over time this can be a significant amount of savings. There is one important thing to think about if you're thinking that you might employ this for yourself, and that is that we can consider a strategy like this because we're late in the year and we can look back over 2021 with a fair bit of certainty that we can estimate Max's taxes accurately. Had Max implemented this strategy, let's say in July, and then found work, he would have withdrawn money from his RSP, anticipated paying tax at a low rate, and then possibly be moved into a higher tax bracket once his annual earnings took effect. The key thing here is that we can look back towards the tail end of a year with much more certainty than we could in the middle of the year when we really don't know what's ahead. So please, if you're likely to do a strategy like this, consider doing it towards the end of the year so that you can at least look back with some kind of certainty. And in fact, I do see many clients reaching out to me in November and December so that we can provide them with, a fairly good estimate of what they could be prepaying for 2021 or in previous years. Now, how do you know if this is going to work for you? Well, like I said, at ETF Capital Management, many people will reach out to me, and at UPotential, people will reach out to me and we'll do sort of a rough calculation. Better yet, what we're starting to implement with the ETF clients is, for those who are interested, we're actually creating a program where we work in tandem with their accountants to implement these types of subtle but powerful tax strategies. So if you're interested in learning more, please let me know. It's a model that's often referred to as a family office model, where a planner works with, let's say, accountants or lawyers or other professionals to try to create a 360-degree strategy for the benefit of the household. Similarly, for the UPotential clients who are interested in the family office model, reach out, because in the meantime, while you're preparing your 2021 tax reporting, if you ask your accountant to prepare what's referred to as a pro forma tax return, in other words, one that simulates your tax burden based on assumptions rather than actual tax slips, these are very useful tools in diagnosing opportunities like the one that I uncovered for Max. Finally, let's give some thought to market timing that actually works. Again, full disclosure, I said it before and I'll say it many times. Everyone would love to be able to buy low and sell high, but this is really nearly impossible to do because highs and lows are only diagnosable in hindsight. However, there are situations where we already know that a stock or mutual fund's price is going to go down. And at the very least, what we can do is avoid buying them immediately before that, lest we see something that we were so optimistic about go down in price very quickly after we've purchased it. So for example, you might be best not to buy mutual funds in late December. The reason is that mutual funds are structured as trusts. And if you're acquainted with that term, a trust is normally very heavily taxed on the investment income that stays in the trust. So what the trust will often elect to do is distribute the investment income to its beneficiaries, or in the case of a mutual fund, the unit holders, who then pay tax on the income at their marginal tax rates. Unlike what I said about RSPs, the nature of the income that's produced in a trust, be it interest, dividends, or capital gains, or returns of capital, anything that's produced in a trust and distributed to either beneficiaries or unit holders maintains its character when it's distributed. And this can often be very tax efficient. Now, the trusts have to pay the investment income at least once a year to avoid having it be taxed inside the trust, as I mentioned, which would be at punitive tax rates. Immediately following a distribution, however, the unit price of a trust, in this case a mutual fund, goes down because the perceived value has been distributed to unit holders. So if you buy units of a mutual fund after it's distributed its value, you will see the unit price go down immediately. Now, most mutual funds elect to distribute late in the year, usually at or after December 15th. And imagine if you bought those units immediately before the distribution, you're going to receive a tax slip for what the fund produced earlier in the year when you haven't enjoyed the appreciation of it. So please pay attention to when distributions are made, because you may very well find that those that you've bought an investment that goes down immediately and that you are subject to tax on. So if you can, maybe defer purchasing those units until January. A similar pattern should happen, but doesn't always happen when it comes to dividend-paying stocks. Now, as you may know, typically a dividend-paying stock pays its dividend 4 times a year, and those dividend payments are usually announced. When the announcement is made, then the company just needs to confirm who the shareholders of record are, and after that date, they kind of close their records, and anyone who purchases the share after the date of the accounting of the shareholders of record is not privy to the dividend when it's paid out. From the date that the dividend is announced through to the ex-dividend date, which is the date where it's no longer trading and the purchasers after that point are no longer eligible to receive the dividend, basically you should see the price of the investment go down. However, because dividends are quite regular, it's unusual for dividends to not be paid. And when they're not paid, you hear about it. You know, if a stock stops paying its dividend, usually it's in the press, and you'll see a lot of press about how the company's in trouble. So I think because dividends, unlike the income produced in a mutual fund, because they're relatively regular and you can kind of hear about when a dividend might not be paid, you'd be surprised that the stock's price may not drop immediately. But at least by way of a pattern, you would anticipate that if anything was anticipated, you would know it immediately after the dividend is announced. So if possible, try to avoid purchasing a dividend-paying stock while it's in that ex-dividend period. And finally, let's just give some consideration to the upcoming holidays. So now, again, full disclosure, I celebrate Hanukkah. So our holiday began a couple nights ago with the lighting of the menorah and eating lots of fried foods, which we call latkes and sufganiyot, and spinning of the dreidel. But of course, you know, I don't live under a rock. I know that we are in the midst of a gift-giving season, and many of us are having difficulty finding the gifts we'd like to give because of the widely publicized supply chain problems and things like that. And, you know, I've faced more than enough times in my life where I've worked really hard to find a perfect gift, only to have the recipient be a little bit disappointed. So, you know, maybe there are other ways to think of gift giving that might actually help you and your wealth. Now, for clients that I've diagnosed as having more money than they need to support their standard of living, we'll often discuss what to do with those extra funds. For those of you who've worked with me, you'll know that I diagnose a term called the maximum sustainable budget. And the maximum sustainable budget is the upper limit of affordability given, you know, what your wealth can support as opposed to what you're actually spending. It's the difference between what you spend and what you can afford to spend. In these circumstances, I'll often suggest that clients offer to fund their adult children's TFSAs for a year. You know, it can be a small contribution, or it can be as large as their children's carry forward room can accommodate. The magic of topping up various TFSAs is that it's a completely legitimate way to pass along wealth in a tax-free manner. Now, one caveat, if you're selling investments to make these gifts, best sell an investment that's relatively what I call tax neutral. In other words, you wouldn't crystallize a large capital gain or a capital loss when the money is transferred. Now, over time, repeatedly funding your TFSA can certainly reduce your own tax burden, but imagine the multiplying effect of actually funding a spouse's TFSA, an adult child's TFSA, an adult grandchild's TFSA. In theory, you could almost eliminate the taxes owing to your estate even. Now, keep in mind that to be ideal and to get the best benefit for you, the gifter, the funds should be coming from a non-registered account because those dollars would otherwise be producing taxable investment income that you'd have to report each year. So those gifts are best done with monies that would otherwise be taxable on an annual basis for you. Another great option is the donation of appreciated securities. This is just an amazing gem of a strategy for those of you who are charitably inclined. If you're not familiar, you can gift shares or units of an investment, like a mutual fund or an ETF, that have appreciated in value. Now, to be clear, I'm not suggesting that you sell the investment and donate the proceeds. You can donate the shares themselves, as long as the charity is equipped to take those donations. Now, if you're donating shares or donating units of a mutual fund or an ETF, the beauty of those gifts is that the donor is absolved of any responsibility for the capital gain on the investment. Again, to bring forward that term I used before, the capital gains inclusion rate that for most of us is 50% right now is zero for gifts of appreciated securities. As an added bonus, you also get a tax receipt for the gift for the fair market value on the date that the charity receives it. So it's actually an incredible way to reward the charitably inclined. So just in summary, and while we wait for perhaps some questions to come in summary, please look at your notice of assessment. Take a look to see if you have any carry forward losses, and then think about where your portfolio is today. If it is like many, you might have appreciated positions that bring your investment allocation completely out of whack that might be worthwhile paring down, both from the perspective of crystallizing a capital gain, in other words, selling high, and if you have those very valuable capital losses, you may not even have to pay capital gains tax to see that happen. Secondly, if you have, for whatever reason, a lower earning year that's somewhat unusual, maybe consider prepaying tax at a lower rate, taking advantage of the fact that whether it's circumstances being less than opportune or early retirement, take advantage of any lower taxable years to maybe take money out of what would otherwise be very heavily taxable sources. And lastly, please at least give some consideration of when your mutual fund distribution date is before you purchase, so that you don't find yourself purchasing an investment that very quickly goes down in value. Okay, I'll just wait a second. I'm just going to give you a little bit of information about how to reach me if you have any questions, as we wait to see if there are any questions coming in. So this is me. This is all my contact information. Again, I'm the head of financial life strategies, both at UPotential, which I described as the fee-for-service arm of Quintessence Wealth, as well as ETF Capital Management, which is the largest portfolio manager under Quintessence Wealth. So if you'd like to work with me through ETF Capital Management, terrific, you can reach me this way. And if you'd like to continue with your current advisor, also terrific, you can always work with me on a fee-for-service basis through UPotential. The next webinar, which is going to be, I hope, sort of in the middle of January, the date to be announced soon, is going to be on how to create financial resolutions that actually stick. So ones that, we all go into a new year with best intentions. How do we make those intentions come to life? All right. In the remaining minutes, I'll just go through a couple of questions. One question has to do with, do I have any suggestions relating to how to manage an end-of-year bonus with tax implications? And the answer is absolutely. So again, I'll take you back to a slide so that we can see the manifestation of projecting your tax burden into the future, and it'll make answering that question a little bit easier. You'll recall when we were talking about Max, in his original plan was to use his cash that's in his checking account to cover expenses, and that would have him essentially have no tax this year, but looming tax consequences between 17 and 19% during most of his retirement years. We suggested, you'll remember, take out a little bit out of his RSP to bring his tax burden to 15% this year, which has sort of a trickle effect going forward. It's a very similar circumstance if you're anticipating a bonus at the end of this year. Bonuses or severance payments that are made at the end of the year are taxable on a full year's worth of income. So they can be very, very heavily taxed. And in most situations, the tax that's withheld at source may not even be enough to cover the tax burden. So typically when you have a balloon payment like a bonus or a severance, normally they're taxed at 30% through payroll. But if you're in a 40 or 50% tax bracket, you're going to have a little bit of a surprise in April as well. So what I would suggest, if you have the opportunity to speak to your payroll department and ask them to pay you your bonus directly to an RSP if you have the room, there's a couple of benefits to this. First of all, you would find yourself with the gross amount as opposed to the net after tax amount for contribution to your RSP. And secondly, the bonus amount would have an equal deduction on your tax return. So if your bonus is $5,000 and you ask your payroll to have it paid directly into your RSP, $5,000 would be paid to your RSP as opposed to after tax it might have been $3,500 or $3,000 that you might then contribute to your RSP. Furthermore, if $5,000 is being put into your RSP, your your RSP deduction receipt will also be $5,000. So there would be an in and out on your tax return, which is a great way both to fund your RSP at a higher level, $5,000 as opposed to the after-tax amount, and at the same time get a RSP receipt for the same amount. So you would have no immediate tax consequences at the same time as you'd have a larger amount being deposited to your RSP. So that's what I would recommend for large bonuses towards year end. Now, there are some who will say, I would just, what if I defer my bonus into the new year? That's a little bit of a harder thing to plan for two reasons. First of all, if a bonus is paid in the new year for work that's done in the current year, please double check with your accountant that it would actually be taxable in the new year. There are some circumstances, don't get me wrong, the vast majority of situations it's fine, but there are certain situations that if a bonus is declared in one year but paid in the next, you might have to report it in the year that it was declared. It's referred to as a work in progress. Like I said, that's kind of isolated, but just double check. I'm a bit of a worrier. Secondly, when it comes to deferring the taxes to the new year, unless you know that your tax burden is going down next year, what have you really achieved other than the deferral of the payment of the tax on the bonus? Arguably, if you think of the time value of money, there might be a little bit of a benefit, but unless you anticipate your tax burden going down, all you're buying is time. You're not actually going to get a reduction in your tax burden next year. And so I think that may be the only question we have today. So thank you to everyone for listening in today. Again, a copy of the webinar will be made available to you on the UPotential website and will be sent to you in a bit of a thank you note as well. But while I have you, may I just offer you health and happiness for the holiday season, whatever it is that you celebrate, and a wonderful, wonderful, healthy start to the new year. Thank you again for listening.